The Bank of Canada is holding interest rates steady for the first time in a year. The central bank says, based on the assessment of recent economic data, the key rate will remain at 4.5%. However, it is keeping the door open to further rate hikes if the economy or inflation run hotter than expected. Recent data shows that inflation slowed to 5.9% in January, while the economy posted no growth in the fourth quarter. The annual inflation rate is still expected to fall to around 3% by mid-year. Well, joining us now to discuss the interest rate and what to expect down the road is Dr. Moshe Lander, economist and professor at Concordia University. Dr. Lander, welcome back to Forum Daily.
Hello.
So this move to keep rates steady was largely expected by economists, but for our viewers, can you unpack the Bank of Canada's decision after a year of rate hikes?
Sure. So we saw inflation in mid 22 above 8%. And like you said in the lead in here, it's now below 6. So all of those interest rate increases that happened in the last 14 months are starting to have the desired effect. And as supply chains are rebuilding themselves, that's taking away some of the inflationary pressure too. So the Bank of Canada is still relying on those interest rate increases that happened last year. And given that they take about 18 to 24 months to have their full effect, they're still waiting on impacts from those. And so they think that they're going to be able to engineer that inflation rate coming below 3%, like you said, in the next 6 months, so they don't feel that any further action is necessary.
So what does this mean for consumers and borrowers across Canada right now?
Well, the good news is that you're going to wake up tomorrow morning to find that your interest rate hasn't changed on any of your loans. So that's good news because the last 8 times that the Bank of Canada has met, you've woken up in the morning to find that all of a sudden it's more expensive to borrow. It's not to say that you should go out then and start using up that line of credit or maxing out your credit cards any more than necessary. But the reality is that at least this is putting some sort of cap then on our borrowing costs. And that's a good sign then for consumers.
A good sign indeed. Now, the central bank has warned that further hikes may be necessary if the economy or inflation run hotter than expected. So, how likely is that given the recent data?
So inflation should come down rather comfortably, I think, right now. The big thing that we need to watch for in Canada is that inflation continues to run hotter than expected in the US. And so the US has indicated that they're going to be increasing interest rates in coming meetings of their central bank. The thing is that that's going to put down pressure on the Canadian dollar. And when the Canadian dollar falls, everybody in Canada knows that's good for exports. But the thing is that when exports start increasing rapidly, that itself could become a source of domestic inflation. And so the Bank of Canada might be forced to go back on their word that they're putting things on pause and start increasing interest rates, not because the Americans are increasing interest rates, but to defend the value of the Canadian dollar and try and avoid some of that inflationary pressure that could come from a quick ramp up in exports.
Definitely something to keep our eyes on. Now, in terms of inflation, we did mention it is expected to fall to around 3% by mid year. Can you tell us a little bit more about what's driving this decline? Is it purely moves by the Bank of Canada?
So it's part that. I'm going to actually correct you here too. I don't know that I'm going to see 3% by the middle of this year. I'm going to say conservatively that it's by the end of this year, but let's not split hairs on that one. The fact is that inflation is coming down in part because the interest rate hikes have taken some of the demand side of the economy and constrained it. Everybody's realizing that it's more expensive to borrow, so we're trying to save money, spend less. But the other part of it too is that businesses are now realizing how to work around COVID and all of the various disruption that's come for 3 years now. And so what they're trying to do is once they can reassemble those supply chains, that's going to take some of the supply side pressure that's been pushing up prices as well. So it's kind of all of the perfect storm of damage that was done in the last 3 years is now starting to go back to business as usual.
All right, Dr. Lander, just about a minute left here, but do you see a light at the end of the tunnel when it comes to inflation and interest rates this year in 2023?
Yeah, inflation is going to continue to come down. I don't really envision that interest rates are going to go up much if they go up at all. I won't suspect that they're going to go down though, so let's not get too excited. But I think that maybe the worst of 2022 is now behind us, and 2023 is going to look a little bit better, at least as far as interest rates and inflation goes.
Good to be positive. Now, just about 30 seconds left here, it seems, but what are you keeping your eyes on in regards to inflation and interest rate hikes for the rest of the year, Dr. Lander?
So I want to keep an eye on those inflation numbers. We get them once a month. And so we want to see that each month those numbers are looking better than the month before and those numbers are coming down. If they don't come down, it's not the end of the world. As long as the trend is down, that's good. If they don't go down, though, I want to see what is the reason for it. And are these one-off factors or is it something that's more sustainable that could cause the Bank of Canada to have to go back and start increasing interest rates?
Lots to anticipate. All right, Dr. Lander, always great having you on Forum Daily. Thanks again for your time today.
Anytime. Great seeing you, Nima.